I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuning in to Traders Nation. My pleasure to have back with us once again Sam McElroy. He's co-founder at Financial and at Financial Investments. Sam, welcome back to Traders Nation. How are you today?
I'm doing well. Thanks for having me. How are you doing?
Doing real good. Thanks for being with us again. So, Sam, if we wanted to start an argument, all right, is all right? I hate to do this, but this thing's going to be out there, and certainly there's going to be a lot of talk around this. Is all we have to ask is, when did the current bull market begin? Okay, and I'm stepping back, Sam. When did it begin? Your thoughts?
I don't know where I really fall in terms of the argument. I kind of see it from both perspectives. I think that there's a strong case to be made when people are looking at in terms of the corrections that we had previously. And typically it takes a correction of 20% or more for us to basically say that we're in a bull market. And when you get down as low as 19.9%, I think we're kind of splitting hairs as far as whether or not that qualifies as dipping into a bull market or not. So I think you're absolutely right that trying to talk about when this bull market began and how long, or whether, the bull market we're in right now is going to be, or we're going to take the title for the longest bull market, is definitely a good way to start an argument, especially amongst Wall Street folks.
That's right. It's fine. It surprises me. In fact, it strikes me that there's no official body that actually that's designated to what constitutes a pullback. I mean, Sam, we've got numbers for everything out there. Why don't we have numbers for that, Sam?
I think it's so that we can argue.
Right. Gives us something to argue about.
Right. It's so interesting that, a lot of the stuff is being defined and changed and updated kind of as we go. Yeah. And in a sense, that leaves room for gray area. And gray area is always going to be the source of arguments and contention. But I got to tell you, when we're talking about things as far as how long this bull market is going, or whether it's the longest bull market, I think that sometimes it really becomes, I don't want to say misleading, but it almost is really good fodder from a textbook technical standpoint. But I wonder from a practical standpoint if it makes us focus on things that aren't as significant in terms of the average investor and what this might mean for them.
Right. That's actually a really good point. I mean, while there are going to be folks out there arguing, if you will, back and forth on what is designated as a bull market, what's designated as a bear market, the average investor kind of really doesn't care, do they? I mean, as long-term investors, they got one objective, maybe several, but the major one is certainly to make sure that they got enough money for retirement. And are they on that path of investing correctly for that, right?
That's right. Because, if we look at this bull market that we're in right now, and let's say it started in 2009, for somebody who was invested in, say, similar or the same securities in 2007, did the bull market really start for them in 2009? Because from 2009 to 2013, they were just making back lost ground from 2007 to 2009 that they fell. Right. So from a practical standpoint, I feel like we can, kind of bang the drums and say, look how great the market's been doing and how long it's been doing it. Right. But for a lot of people, they may not really have experienced that. And to take it even a step further, what about people that were retiring sometime between, 2007 and 2013? From a trajectory, from all the assumptions they probably programmed into their retirement calculators and everything else like that, it may or may not be conforming to their experience. And so I think sometimes we can get really technical and start looking at a lot of these pieces. But for somebody who had enough to retire, but not so much that they could be careless, I think the reality may be super different.
So let me frame that a little bit. So what we're saying here is that, certainly some would argue that the bull market started on the upswing back after 6,500 when the Dow hit that low. But like you said, a lot of people took a haircut, man. I mean, they really took a beating. And even though that from 2010 and up, when it started to recover back up to where it's at now, it took years for people to recover to even break even. So they may not necessarily feel that they were in a bull market. They were in I'm trying to break even market, right?
That's exactly right.
Yeah.
And I think sometimes we lose sight of that. Now, for somebody who maybe is more sophisticated, or for institutional traders or something like that, who maybe had new programs, new strategies where they were putting new capital to work around 2009 and 2010. Well, okay, yeah, they got the full brunt of all of that. Yeah. But we know that the average investor is more of a buy and hold investor. So, more likely than not, they were just riding the roller coaster.
Yeah, totally. Sam, now there's a lot of talk. There's going to be another big correction. That remains to be seen. Certainly, we'll see one. I mean, nothing goes up forever, okay? Certainly, we know that. So what is the average investor on the street? How are they going to protect themselves from the next time we see a big pullback from the market?
It's such a great question because hindsight is always 20/20.
Right.
My personal feeling is that, not because I think the economy is bad,
right,
but because I think the stock market rose so quickly, I think that we are out of alignment with respect to fundamental economics. And what that basically means is that if I had to fall into one of the two camps, I'm also anticipating a severe correction in the market. Now, the question is, okay, to what magnitude? And I don't say this because I want to scare anybody. I'm just trying to rely on analysis, because at the end of the day, you have to have a lens at how you interpret data.
Right.
My personal feeling is that I think that the 80s and 90s was what we call a secular or a long-term bull market.
Okay.
I think, yes, we had the savings and loan crisis in, 87, and that was certainly unfortunate for a lot of people.
Yeah.
But generally speaking, people that were in the market in the 80s and 90s were rewarded for being in the market. I think in the year 2000, really starting with the NASDAQ crash and the dot-com bubble, I think we switched into a longer-term or a secular bear market, which usually is earmarked by more volatility. You kind of bounce down and recover and drop and recover, and you do that for a prolonged period of time.
Okay.
So if that is true, and we are in a secular bear market, and if history tends to repeat itself and we're looking at other similar markets, the expectation is that we should come back down and touch where we were at the start of it, which would be where we were in the year 2000. Now, to do that, we're talking about a 45% pullback in the equity market.
Wow. Yeah.
So could it happen? I don't know, but it's in the realm of possibility, I think. But even a 20%, which would put it in the realm of being a correction, I think would still be potentially harmful for a lot of people.
Yeah. I got to tell you, people are nervous like cats, man. I mean, they're like claws in the ceiling. They don't want to and now their 401s are back, their personal IRAs are back, even their trading accounts, they're back, okay? People are just scared like crazy. So the biggest question here is if we're going to see a 20% or maybe 40%, like you said, best way to hedge against that. We're almost out of time.
Yeah, best way to hedge against it is really to make sure that you're not risking money that you can't afford to lose. So money that you need for income purposes to live off of, I think now is a good time to start taking some chips off the table, realigning some things.
Sure.
But for people that have substantial savings or enough that they can afford to let it bounce around a little bit,
right,
I think it's okay to continue playing some of those market games.
Yeah. Do they put it in cash? Because cash, the inflation evaporates cash. Where do they put it?
Yep.
Is that where they put it? Cash? Flight to quality is cash?
Yeah, mixture of things. You can have some in cash, poised for market reentry, but I think another alternative is to invest in things that are focused more on income.
Fixed.
So, we always forget that total return is a combination of income and growth. So when the growth looks limited, you start to move towards more of the income plays.
Maybe like some fixed income stuff?
Yeah, definitely looking at some corporates, as long as they're individual holdings and actively managed, some preferreds, other things like that.
Okay, Sam, where can we find you at? Website?
Yeah, easiest place is the website. It's www.atfinancial.com.
apfinancial.com, apfinancial.com, or atfinancial.com, rather. Sam McElroy is with us here today, co-founder of @Financial and @Financial Investments. Sam, thanks for being with us.
Thanks a lot.
You bet. Have a great day. We'll be right back. Stay tuned.
You too.